Hey, I'm Tom Lydon with ETF Trends, and I'm here with the co-founder and CEO of Riskalyze, Aaron Klein. Aaron, great to see you.
Tom, so great to be with you today.
Hey, as we started out 2022, talk about volatility, talk about risk. That's kind of been the story of the day, huh?
My goodness, I feel like it's been the story of the decade, right? I mean, we said in 2020 that this was going to be the risk first decade, and I guess I couldn't have predicted, what we're all seeing in our world right now with Ukraine and Russia, and just everything that's going on. It is interesting times in our world, and that's translating into interesting times in the markets. And yeah, couldn't
Yeah.
quite have foreseen this, but it's a risk first decade, that's for sure.
Well, we want to talk about today, but I'd love to kind of backtrack a little bit and back to the early days.
Sure.
When you first started Riskalyze, what was the thought process there? And maybe take us back to some of your key thinking behind Riskalyze.
Well, they say that anybody who is dumb enough to start a company has to be like, just crazy or insane. But it is, typically best to be obsessed with solving a problem. And, for me, I was running a product for a division of an options brokerage firm. I was watching how the average individual thought about risk. And I actually said to my future co-founder, it is crazy how the average individual thinks about the concept of risk. And he said, if you think that's crazy, you should see how many of us financial advisors think about it. We just have not had the tools in our profession to really understand who our clients are and match that up to the amount of risk in their portfolios. And when you double clicked on that idea and we really dug into it, we realized that there was just so much about this profession that was based on these qualitative terms like conservative and moderate and aggressive. And it's the equivalent of trying to build like the office building that I'm sitting in right now. And if the contractor and the architect communicated by saying, remember, he wants a moderately conservative hallway leading to his moderately aggressive conference room. Like there's a reason they put feet and inches onto the blueprints.
Yeah, yeah,
And so
absolutely.
we said, gosh, we got to put the feet and inches into this process for financial advisors.
So
And that,
your co-partner
yeah,
was an advisor himself.
he was a financial advisor himself. And
Okay.
he ended up joining full time a couple years into the company's history and was our chief investment officer and really helped to shape the risk methodology as we grew.
Well, let's talk about that because
Sure.
this risk methodology is really the core of your offering. And
Yep.
I gotta believe not only your clients, the advisors are happy, but it may be helping their clients through these tough times.
Well, for sure, and that's really what we believe in, right, Tom? Is that we believed in that immediate moment that like if we could help those financial advisors build their clients a short-term framework to understand how to react to risk appropriately, that would be a really powerful thing. Because it actually, believe it or not, was a little controversial that the word risk was in our name when we
Yeah.
started the company. They're like, what? There's two things advisors never talk about, and it's not religion and politics, it's risk and the short term.
Yeah.
But our response was, hey, the problem is that your clients react to risk in the short term. So we want to build a short-term framework to help them react to risk appropriately, because that's how you transform a fearful investor who makes bad decisions into a fearless investor who makes really great decisions. And ultimately, what every financial advisor needs to do the amazing work that they do is a client that gives them a series of great decisions.
Well, the thing I love about this is it forces clients to actually go through a series of questions. So ultimately, they come up with their own personalized risk score from
Yep.
one to 100.
Yep.
And I imagine that many are surprised when they get that ultimate number.
It's 1 to 99 because I've got the Risk 99 license plate on my car. But
Okay, I got you. I
point
got
that
you.
out. Yeah. But no, you're right. And here's what's really surprising. It's not actually the first time you get the number back. A lot of times people just look at that and they're like, yeah, that feels like me. That's me. That is me. Okay. What's really surprising is when the financial advisor flips over the card and shows them how much risk they're carrying in their current portfolio. Okay. Because for a lot of those advisors, they're meeting with a prospective client. The clients are risk 45. Turns out, their portfolio is like a risk 82. Okay. That client all of a sudden like sees it. They go, that's why my portfolio is bouncing around more than I feel comfortable with. Or the flip side, the client's a 62 and their portfolio is invested like a 31, okay? And
Right.
they're looking at that and going, this is why I've always been frustrated that my friends are doing better than I've been doing, right? And so we at Riskalyze, we call that the ACAT form moment, because that's when an advisor gets the opportunity to bring that client aboard and then better level set their expectations so that when we get into these times of volatility like today, I'm prepared. I have my expectations set. I know what is normal for my portfolio.
So fast forward to today, and we've
Yeah.
had a lot of volatility. What would you say, some of the key things that advisor clients are getting out of this? And then most importantly, would you say by having an advisor's client go through this, that their phone isn't ringing as much as others?
It's a great question, and the number one thing that I would argue the active client and advisor is getting out of this is the ability to understand what's normal for the portfolio and therefore to have the right kinds of expectations. Because and it goes right to the phone, the phone ringing point that you just made. Because if my financial advisor has reviewed this with me on a regular basis and has showed me that, hey, my risk 48 portfolio has a 95% historical range of operating within kind of a -8 to +12% range, in a given 6-month period. Then when my portfolio is down 3-4%, like maybe, this time period we're in right now with all this activity in Europe, I am not calling my financial advisor as much, right? To go, we're down 3 or 4%. Am I okay? We've already established that -8 to +12 is kind of the zone of normal for this portfolio. So it really does tamp down those client concerns, and it gives the financial advisor a really great language to level set that when the client does call. A lot of advisors love to talk to their clients during that point in time, but what they need is a great language to say, hey, remember when we talked about that and this was normal? Like, we're still in that
Yeah.
95% range. And by the way, this could be one of those 5% probability events where it drops below the range.
Sure.
But if that were to happen, the worst thing we could do is sell at the bottom of a 5% probability event. We want to, we know that history. We saw it happen again in 2020. The people who sold at the bottom of the 5% probability event didn't benefit from the snapback that the markets gave us after that.
So if I'm a 65, you're going to give me a range that I'm usually going to operate in,
Yep.
and there might be a 5% chance I might go below or above that range over a
That's
certain
right.
period of time.
That's right. And that 95% range, one of the things I like to say is it flips the advisor from losing 95% of the time to winning 95% of the time with their clients. What do I mean by that? Typically, a financial advisor, when they're talking with a prospective client, the client goes, what can I expect out of that portfolio? And the advisor, kind of says, well, look, I can't tell you what the markets are going to do. I can't tell you where that portfolio is going to go. But the client kind of says, you're going to have to tell me what to expect, or I'm not going to just wait 30 years and hope that you're right. And so the advisor usually is the one who says, well, look, over the long run, this portfolio should probably average 8% a year. And guess what? The client only heard 8% a year, right? So if the market is below its own average, they're pissed off because they didn't get 8%. If it's above its own average, right, they're like, well, the market got 16%. Why did we only get 12? So the advisor is losing 95% of the time. We want to flip that and say, here's the normal range for your portfolio. And then the advisor's winning 95% of the time.
Yeah, I tell you, my wife would like to talk to you because I'm always telling her, 40 is today's 60. And in this case, I try to act like an 80 when I'm really a 60. And
Well, we'll get you the Risk 80 license plate for your car.
good. At least I have a license plate, right? In my portfolio saying this. Aaron, hey, thanks for the time today. Congratulations
My
on your
pleasure.
success. I
Thank
look
you.
forward to seeing you face to face soon.
Thanks, Tom.
Thank you.